As Olivier and I agreed before the conference that our speakers are so well known they get no intros, and so that will continue. So I would like to ask to start our panel on financial stability, Andrew G. Haldane, Chief Economist of the Bank of England.
Thank you, Adam. Afternoon, everyone. It's a huge privilege to be here with such a distinguished set of panelists and audience on a topic that, in truth, I haven't thought much about for the last 3 or 4 years until recently. So I'm really grateful to Olivier and to Larry, to Adam for the chance to try and catch up with the research there's been over the last 3 or 4 years and try and bring that together. What I'm not going to do is say anything radical about what might be done next for 2 reasons. One, job preservation. Second, more importantly, we have already gone through, have we not, 10 years of pretty radical regulatory reform. And the system of regulation that we've landed on is really a very different animal than that with which we started a decade ago. There are many more moving parts. The constraints, the regulatory constraints are longer singular, they are multiple. The system itself is materially more complex than was the case pre-crisis. And the degree of discretion embedded in that regime is also materially greater. So I thought, given that wholly new system, this was as good a time as any to have a stock take on where we've got to and see where the new evidence and research suggests we might be going next. And let me, in the time I have, just flag 1 or 2 areas I think which might warrant further attention. Now, a few years ago, I did make some comments that were taken to be a rather more radical set of proposals about how regulation might change. And I used the metaphor of a dog catching a frisbee, of the way in which we might move our regulatory system so that it might be based on something more simple and singular than the complex and multiple regime we were designing. The idea here, which I'll sort of demonstrate if this works. Let's see. No, it will. Give it time.
That's right. You sent us this infinitely large file.
Yeah. Talk among yourselves. That one. Oh, it was down rather than up, sorry. This is a dog catching. It's interesting. The dog runs not in a straight line. It runs in a parabola like a baseball player catching a ball. So the angle of gaze is constant. It rises perfectly, it jumps, and... Now, if anyone else sends me that video with a message, the leverage ratio doesn't work, I shall kill them. But the important point here, I think, is that sometimes you need some insurance. Too much focus on the frisbee and too little on the camera, in that case, can get you into trouble. And do you see the dog's face, by the way, when it missed? Scorch into my conscience, that picture now. And actually, one of the messages from today was the need for a degree of robustness in the control engineering sense when dealing with future problems. So we've been through what is the biggest regulatory reform program since at least the Great Depression, and that's been fully warranted because the costs of crisis have been every bit as great as those which followed the Great Depression, whether measured in real GDP per head terms or in fiscal terms, in government debt terms. So although the integral of output losses from the Great Depression, red, relative to the Great Recession, green, are somewhat less, the level of GDP is tracking similarly 10 years on than followed the Great Depression, looking here across the UK, US, France, and Germany. If you looked at the paths of debt stocks relative to GDP, notwithstanding Larry's caveat, the rise has been greater, and there are fewer signs of that tailing off 10 years on. So costs very considerable and fully justifying the reform program that we have seen put in place. This summarizes in one slide some of the key planks of that regulatory reform program. I will not go through this. It is, as you see, an alphabet soup of acronyms, many of them new, covering, broadly speaking, some things of a more microprudential nature, focused on the fortunes of individual firms, some things of a more macroprudential nature, focusing on stability of the system as a whole, and a bunch of other stuff, often related to non-banking as much as banking, around governance, pay, clearing, accounting, and what have you. In the time, I'll focus on the micro and macroprudential reforms that have been put in place. The paper, which is 50 pages long, was made available about 10 minutes ago. So I hope everyone's read it and digested the main messages. That contains other stuff on these other dimensions that the panelists, I think, might pick up. Well, here is what has happened in a static sense. Two balance sheets. Here, look at a panel of the world's 200 biggest banks, the 30 designated GSIBs, that is, globally systemically important banks, and the roughly 160 DSIBs, that is, domestically systemically important banks, a measure of capital, a Tier 1 capital ratio, and a measure of liquid assets. And roughly speaking, the pattern is that that regulatory reform agenda has, it seems, had some purchase. Levels of capital are materially higher. Levels of liquidity are materially higher. To give one example, so Tier 1 capital ratios have gone up from an average, perhaps, 6 or 7 or 8% pre-crisis to closer to 13 or 14% now. And the financial markets have reached their own verdict on these reforms. It's a slightly nuanced, slightly nuanced picture as Larry's paper with Natasha Sarin sets out. It does look like financial markets are pricing for a more resilient financial system than was the case pre-crisis. So left-hand side picture, a measure of CDS default spreads for those GSIBs. They are materially lower than their crisis peaks. They are still higher than their pre-crisis lows. But if you assume, I think not unreasonably, that risk was being chronically underpriced pre-crisis, the story would tell of current levels is of a more resilient and somewhat less risky, at least in a static solvency sense, banking system. The flip side, though, which Larry's paper also talks about, is that banking looks like a materially less profitable business than was the case pre-crisis. The right-hand side panel, a measure of the price-to-book ratio of those same global banks, points to that being a lot lower than pre-crisis and currently hovering around unity. And in some ways, that rather nuanced picture about what financial markets are telling us about financial system risk begs the obvious question about whether enough has been done to repair the system's resilience. This is an ongoing area of debate academically and within policy circles. We know here what we should be doing as God-fearing economists, which is to equate the marginal social costs and benefits when determining some optimal capital ratio, for example. And in fairness, that was just the approach that was taken by regulators back in 2010 when figuring out how much extra capital to put into the financial system. And once that marginal cost, marginal benefit calculus was done, plugging in some estimates at the time, this so-called long-term impact study settled on some optimal ratio, roughly in the 16 to 19% range. Now, you'll see straight away that that number is some way north of where most banks, most of the world's biggest banks, currently have settled. Roughly two-thirds of both the GSIBs and the DSIBs would be currently operating at levels of Tier 1 capital below those suggested by that Basel Committee study back in 2010. And that begs the obvious question, is that justified? What have we learnt subsequently, quantitatively, research-wise, that might justify that somewhat lower calibration? Well, in the paper, we go through in some detail the research that's become available over the last 10 years or so that speaks to both the costs and the benefits side of the ledger. This simplified table tries to bring that together with benefits at the top and costs towards the bottom, and the arrows to the side showing what our view is on the balance of evidence as to whether capital might be north, arrow pointing up, or south, arrow pointing down, of the levels suggested or calibrated back in 2010 by the Basel Committee. Just perhaps picking up one or two points here on either side of the ledger that might point towards either higher or lower levels of capital than those suggested back then. Well, there has been a set of work that's looked at, for example, what impact capital has, not so much on the probability of a crisis happening, but on its subsequent severity. Back in 2010, the Basel Committee made no allowance for higher capital reducing the severity of subsequent crises. Evidence since suggests that capital, money in the bank, if you like, however, can materially reduce the severity of a crisis once it has broken. That's been true on average looking across a long time span, say back to 1870, across a set of countries. And it's also true of experience during this crisis, as the left-hand panel shows. This is the same panel of 200 of the world's largest international banks. It compares their pre-crisis Tier 1 capital ratio, measured horizontally, and the subsequent, in other words, post-crisis growth in credit by those same banks. And it tells a story of those banks that had highest capital pre-crisis have predictably been those best able to lend when crisis has struck, therefore supporting growth in the economy and reducing the severity of crises. On the second dimension, which points in other words, taking account of this effect, would, other things equal, point towards higher optimal levels of capital than found back in 2010. A second factor that points broadly in the same direction is that the study took some account of the fact that the act of raising extra capital might raise the cost of capital for those banks, constrict credit, and therefore have some collateral damage on the wider economy. A number of studies have since looked at this. A number, have concluded there's little evidence of credit conditions having been impaired by this raising up of capital. Nonetheless, if you do the same thing in change space, this looks at the change in capital ratios among those same banks and compares that with the growth in their loans subsequently. There is some evidence that those banks that had furthest to travel to reach these higher capital standards have done more to constrict their credit growth. When I compared the slope of this line in the right-hand side panel with the implied estimate from that Basel study, they are almost identical. Whether that was perfect foresight or complete fluke, I'm not sure. But either way, it suggests that study was roughly in the right place. So what is it then that is on the other side of the ledger that might justify why most banks internationally have landed south of that study? And the key swing factor here is circled in the benefits part of the box, which is the impact of improved resolution arrangements and the higher quantum of potentially bail-inable bank liabilities that have been issued. This was not taken into account at all in the earlier study, yet it seems plausible that that bail-inable debt would, if bailed in, reduce both the probability and impact of crisis. Indeed, may also reshape the risk-taking incentives of those running banks ex ante. If you take those effects into account, that by itself might lower the optimal capital ratio by several, perhaps as much as 5 or 6 percentage points. I'll come back to that, because in some ways that is the key judgment justifying where we have landed capital-wise internationally. The second issue I thought I'd touch upon, again pretty briefly, is the way the overall shape or system of regulation has evolved in its most recent incarnation. It has become multiple rather than singular, more complex and more discretionary. I thought I'd focus on the first of those dimensions, which is the costs and benefits of having moved to a genuinely multipolar rather than unipolar model of regulatory constraints. Earlier on, Olivier talked about the belt and suspenders issue, actually. So I didn't use that expression because suspenders in American English and suspenders in English are very different things. And the thought to an English audience of a regulator in belt and suspenders is not worth contemplating for too long. Anyway, several papers recently have raised questions about whether the current regulatory infrastructure might be in some senses suboptimal. So Steve Cicchetti and Al Kashev of the paper suggesting that the system is over-identified. Some of those constraints are redundant and could be gotten rid of. Jeremy and co-authors a very nice paper, which I'm sure we'll discuss in greater detail, about how this multiple set of constraints may be distortionary for banks' business models, and indeed a homogenizing force, which could in fact be bad for stability. That too is a compelling set of arguments. And of course, with multiple constraints come extra costs and complexities, which also need to be weighed in the pot. Truth be told, I think these arguments are pretty compelling, speaking personally. Nonetheless, it's important for reasons of balance, I think, to set out why it is regulators arrived at this complex, more complex, multipolar box of tricks in the first place. And for me, three arguments here are perhaps most important. The first of which is a sort of variation of the Tinbergen principle, which is that if you have a financial system that exhibits multiple fault lines or frictions of various types, you might then need a multiple set of instruments to speak to each of those fault lines. Some banks failed for reasons of too little capital, some for reasons of too little liquidity, some for reasons of inadequate funding structures. This in some ways is the, if not so much the Tinbergen, it's sort of Tolstoy principle of regulation, which is that, you know, all good banks are roughly the same. All bad banks fail often for quite different reasons. We need multiple constraints to speak to those different sources of unhappiness. Secondly, if we could perfectly calibrate, or even decently calibrate, the risks that attach to different assets, I think a risk-weighted system would make perfect sense. The truth is, it is extremely difficult to calibrate with any accuracy the scale of those risks. Anyone who's looked in any detail at the risk models banks use, you'll be in for a shock, because they're not really kind of models at all in the sense we typically think of them. They're sort of things. They're things, really. Data-based things, usually based on short samples, that fit kind of okay, usually overfit, in sample, but partly by dint of that, are incredibly fragile out of sample. And if those uncertainties are acute, as I think they probably are, there is a case for diversifying with your instrument set in a Brainardian sort of way. The third argument I'll not touch upon here, but is covered a bit in the paper. Now, how best to get your arms around how important these arguments might be? Well, the one way is to look at the evidence, in particular evidence drawn, thank you, Adam, from the crisis. That, of course, is by no means, need not be compelling. History is another country. The regime has changed subsequently, but nonetheless, the experience of the last crisis might be revealing, I hope is revealing, of what those fault lines were, how great those uncertainties might be, how counterfactually different regulatory regimes might have performed had they been in place in signaling bank distress. So with those caveats in mind, let me show you one or two bits of empirical evidence that speak to this question of multiple versus singular constraints. What I'm doing here is I'm taking a panel of banks, around 100 of the world's biggest banks, pre-crisis. I'm asking the question, what would different regulatory ratios or thresholds have told us pre-crisis about their likelihood of failure? What I measure here vertically is a measure of the hit rate. That is to say, if a bank was in breach of that regulatory threshold and subsequently failed, that is a hit. Whereas if otherwise it's missed. And if it signals a false alarm, in other words, if that trigger is breached, but the bank subsequently does not fail, that counts as a false alarm. That's measured along the horizontal axis. So, of course, you want outturns for regulatory constraints that lie above the 45-degree line. That's a kind of coin toss line, if you like. The further above these lines lie, the better performing was that ratio in signaling distress. In other words, a higher hit rate per unit of false alarms. What this line does, the blue line here, is trace out a set of hit rates and alarm rates for a single leverage ratio, calibrated at different levels. And the circled bit here is a calibrated leverage ratio of 3%, which is where the international standard has settled. And at that calibration, roughly 70 to 80% of all banks that did subsequently fail would have been correctly signaled, with a false alarm rate that is reasonably low at about 20%. Indeed, this kind of mirrors the evidence that suggests that of all the metrics of banks' solvency and liquidity pre-crisis, the leverage ratio did better than pretty much all of them in signaling subsequent distress. But, and the but's important, imagine that you, as a regulator, weren't happy with only capturing around 80% of those that fail. Let's say that's too low a tolerance for failure in your book. You want to set a lower tolerance for failure. You do that by upping your calibration of the leverage ratio. You start traversing this way. You see, at this point, the leverage ratio starts performing much less well. In other words, you can pick up those failing banks, those extra failing banks, but at the cost of a much larger fraction of false alarms and a much tighter calibration of regulatory standards. The ratio of marginal costs to marginal benefits becomes significantly more adverse for a lower tolerance for failure. Now, if you move, however, from these singular constraints to a set of a more portfolio approach, shown here on the right-hand side panel. This is a portfolio of leverage, risk-based capital, and liquidity, shown in the black line. You can now reach this point here, which is to say a higher hit rate while maintaining a still only modestly higher rate of false alarms, and, as importantly, a lower calibration of regulatory standards. In other words, that portfolio of instruments can help in achieving a Pareto preferred point. Higher hits per unit of false alarms at a lower calibration, for reasons related to those Tinbergen and Brainard points that I mentioned earlier on. This is not a knockdown argument. Who knows whether counterfactually this would apply next time round with a regime different, but it is nonetheless, I think, interesting and revealing. Let me, in my remaining 1.5 minutes, Adam, thank you, tie up with some points I haven't touched upon. On calibration, the big key question there is resolution and how credible we think it is in future crises to bail in this debt, particularly in situations of systemic institutions failing in numbers. That is genuinely an open question, and given its criticality to the calibration, one I hope that future research might look at more comprehensively than has been the case so far. On the question of multiple constraints, it might well be the case that some streamlining or simplifying a la Jeremy's proposal is in order. I think if we are to go down that path, which on the face of it sounds desirable, the key question is robustness in that control engineering sense to multiple fault lines and those uncertainties that I mentioned. On stress testing, central banks and regulators love stress testing, and the real question is how far should we spread that love beyond banking into market-based financing of various types. On macroprudential, Olivier, earlier this morning, spoke about how pre-crisis we'd spent much time with Talmudic recalibrations of the coefficients on Taylor rules. When it comes to the macroprudential reaction function, we are still really in the foothills. We're not even re-optimizing coefficients. At present, we're still discussing what arguments appear on both left and right-hand side of that reaction function, and much further work to be done in defining and refining how that is for reasons of transparency, but also for reasons, penultimate point, of political economy. As several have mentioned today, macroprudential takes us deeper into the realm of political economy, not least because its actions are often overtly distributional in nature. And last, but by no means least, two questions that in some ways sit above all of the others, but are relatively little looked at in regulatory circles. The first of which is whether the financial sector could in some sense be too big. At one level, that sounds like an interesting question, maybe an odd question. We don't ask, for example, whether the pharmaceutical industry or the car industry is too big. Then again, given the collateral damage finance can do, I think this question is a relevant one, and there is some evidence that suggests that indeed you can have too much of this good thing called finance in a way that is growth and productivity depleting. Last and very last point, fintech. I am optimistic that could indeed be transformative for the future structure of finance and also, therefore, for the future structure of financial regulation. The form of finance could change radically. What were dogs and frisbees in the past may in future be a different set of animals chasing different objects. And on that front, and on that note, Adam, I will stop. Thanks very much.
Right. Well, thank you, Andy. I look at this panel and I'm awed by its intellect and its real-world relevance, and then I worry these are too many insiders. So let's see where this discussion goes. Let me turn first to Marcus Bernemeyer of Princeton University.
Great. Thanks a lot for inviting me. It's a pleasure to be here. It's always hard to follow up on Andy because I don't have a frisbee and I didn't bring a dog either. So I recommend highly to read this piece of work Andy wrote with his co-authors, which covers a lot of ground. It's very detailed and it's very comprehensive of what happened in the regulatory framework. And it also goes into macro models, to what extent we can use these macro models to calibrate, what capital requirements we need and all the other dimensions Andy mentioned. So rather than going over the whole things, because it covers too much in my 8 minutes, I will just highlight 5 different points, I think, where there were shifts in our thinking in the last few years, how to deal with that. The first thing I would say within the macro models is a shift away from thinking about stocks and flows to think much more about the risk focus. And I will mention this paradox of prudence compared to a paradox of thrift later on. The second dimension I would like to mention is the focus before the crisis was very much on the risk of a financial institution on its own and the risk in isolation, focusing much more on the spillovers, the externalities an institution can cause onto the system. That was a fundamental shift how you measure risk and how you capture risk. And the third dimension is more on the time dimension, where it's essentially saying if you measure volatility, current volatility is very low, that's actually not a sign that the system is healthy. It might be a sign that there's some risk building up in the background. Okay, so that's what Olivier mentioned earlier on. So it can be very misleading if current volatility measures are very low. That's the volatility paradox. The fourth dimension I would like to mention is this separation principle we saw before the crisis all over the place. You put things in little boxes and you treat them in the box separately. And we saw that actually many of these things, in particular prudential policy, which is now macroprudential, is very closely tied to monetary policy. And monetary policy has a lot to do also with shifting wealth around and recapitalizing certain sectors. And finally, I would like to contrast some stability focus and contrast it with some resiliency dimension. Okay, let me focus on the first one. The first one is shifting from a focus on stocks and flows to much more focusing on the risk dimension. What I mean by the risk dimension, of course, we always had models where there's some uncertainty and risk in it, but to focus on the volatility dynamics itself, rather than have a one-time shock and then you see how the impulse response is and how you go back, you focus on the whole volatility dynamics, how the volatility will play out. If you have one-time shock, is the volatility going up further or further down? What's the whole volatility dynamics? I think this is very important to focus on these higher order moments, because it then also feeds back in precautionary savings and consumption behavior and so forth. And also one aspect which played out very prominently in the crisis was this flight to safety, flight into safe assets, and the role of safe assets, which became way more prominent in the crisis and in the research as in large, and feeds then back then in the optimal regulatory framework. And let me contrast this just with two paradoxes, and Andy mentioned this in the paper, this fallacy of composition, which is very, very important. You should not consider something which is true in the microsphere is also true in the macrosphere, and that's the famous Keynes paradox of thrift. If everybody is more thrifty, spends less, your spending is my income, essentially, then my income is going down. And if everybody lowers the marginal propensity to consume, actually, at the end of the day, I try to save more, but in dollar terms, actually, I might actually save less because the economy contracts because of that. You can do a similar thing, and you and I were pushing this term, paradox of prudence. When you try to be more prudent, instead of cutting back your spending, you actually cut back on your risk-taking, so you're less risk-taking. Actually, this increases the endogenous risk in the system. So everybody tries to take on less risk, but by doing so, actually, endogenously, the risk in the system is going up. So what's micro-prudent is actually not macro-prudent, because by being more prudent on your own, on your microsphere, and bank regulation is imposing it on you, then actually you create more risk in the macrosphere, and that actually makes the whole system much more volatile, and actually that's very counterproductive. So the same thing you can do in the stock and flow basis on the Keynes consumption savings decision, you can also do in a portfolio choice decision on the risk space as well. So that's the first this movement away from impulse response functions, one-time shock and have an impulse response, much more to overall analysis of the whole volatility dynamics, how the volatility dynamics is playing out. The second aspect I would like to mention is, which is not in a time dimension, it's much more in the cross section, is focus away from the riskiness of a financial institution, how likely is it that the financial institution is going under, but the riskiness of financial institution being in difficulties causes on the whole system. What are the spillovers? What are the externalities in terms of risk on the system? And these spillovers come in two flavors. One of the spillovers are direct contractual links. So if we have some contractual connections, there's a whole network structure. You can actually figure out how the bankruptcy of one bank causes a bankruptcy for the next bank and so forth. And these are the first network domino effect type of spillovers. And then, of course, the indirect ones, which turn out to be way more powerful than the direct ones. And that's through some liquidity spirals to common exposure to similar assets. So there will be some fire sales, the asset price is going down, and that drags down others as well. And that can, again, come in the level space where the asset price is going down. It can also come in the volatility space where the asset price become more volatile, hence the margins are actually going up. And that's why it forces people to delever, so the value at risk is going up. People have to delever, and this actually feeds on its own, makes the situation even worse. And what's the fundamental difference between the first one and the second one? The first one you can characterize very nicely because you know when a bank goes bankrupt, then it will cause on some direct spillover effects. The second one depends on the behavioral response of the particular player in the marketplace. So you have to figure out what is the behavioral response, and that measuring this behavioral response is way more difficult. And then the outcome is a general equilibrium outcome. There's a lot of feedback effects and amplification going on. So what one needs essentially is some response indicators. So we have to collect data not about positions or something, but on something, on the funding conditions combined with the market liquidity of these positions, which indicates will this particular player be a shock absorber or will it be a shock amplifier? So essentially you can classify things. If you have these response indicators, you can say, oh, these institutions it's more likely to, when there's a negative shock, it will actually contribute to the shock and will amplify the shock. And the other institution is, this price is going down, it sees it as a good buying opportunity, is actually providing liquidity, it will be a shock absorber. So to classify these institutions in different ways. And you can, like in the domino effects, you can build up a network with virtual links, which, because they're not contractually linked directly, there will be virtual links, but you can say some of them are shock amplifiers and some of them are shock absorbers, and depends where the network they are placed, how stable the whole network is at the end of the day. So that was a second dimension. The third dimension is, again, the volatility paradox, where essentially, if you measure contemporaneous risk with the value at risk or some volatility measure, it can be very misleading. Right now, all the volatility measures are very, very down. That actually can be very misleading because this leads to lower margins, as I mentioned earlier, leads to more higher margin debt, higher leverage, and that makes you vulnerable to some more risk down the road. And then when there is a shock and you're vulnerable to a shock, then actually suddenly the value at risk is shooting up, and then you suddenly have this huge adjustment and the whole thing goes in reverse. You have this risk on, risk off phenomena playing out. So you have this huge procyclicality, and the paper talks at length how the countercyclical buffer helps to overcome this procyclicality. The old Basel II framework essentially was very dangerous in this regard because the risk weights were to some extent very much related to the value at risk, and if having this countercyclical buffer is actually helping on this dimension. On a more subtle note, you can show in models that actually, if you have a financial system which can better ensure idiosyncratic risk, endogenous risk of the system is actually higher. So actually, going from a very incomplete market setting to a less incomplete market setting, you make the whole system less stable, because essentially if you ensure people's idiosyncratic risk, they will take on more leverage, they bet more along the aggregate risk dimension, and then it makes the whole system more risky. So these are all complications which we have learned during the last, and the paper touches upon them, and that makes calibrating macro models or finding the right macro models challenging, because whether you put this mechanism in or not, it affects very much your calibration of capital requirements. So let me just illustrate this build-up. There's just a little graph, the build-up of this risk in the background. 2 minutes. Okay. So the buildup of the background. So if that's just a best response function as a function of what the others are doing. And when the risk is building up in the background, nothing happens. You have this equilibrium up there. This is this red dot. And it's only what happens is actually the best response changes, but you don't see the best response because it's off equilibrium. But now if there's a shock occurs, then actually you move down dramatically because there's first amplification, and later on, there's also multiplicity in this particular example. We can jump to a much lower equilibrium as well. So the high nonlinearity showing up. The fourth dimension I would like to mention is that macro-pro and monetary policy are highly connected. I think there is a tendency to have separation principles everywhere and have little boxes to put this together. Why is this so highly connected? If you look at emerging economies, it's always the case that what was macro-pro now in the advanced economies is actually part of their monetary policy toolbox in the emerging economies. Of course, they are connected also because most of the money is created by the banking sector. So inside money is created by the banking sector. And we know that, in downturns, the banking sector shrinks, and the banking sector will not take out so much idiosyncratic risk. More of this risk is then held by the households, so money demand goes up. So just replacing the missing inside money with new outside money, that's what the monetarists would do in order to keep the total money supply constant, is actually not enough, because inside money and outside money are not substitutes from a social perspective. And that's something where we have to be very aware of that these two things are not separate from each other. They interact, and hence we need coordination, as came up many times before, between fiscal and monetary, but we also need it between these two authorities or these two branches of stabilization of the macroeconomy. And then there's, of course, the whole balance sheet of a central bank is highly interlinked with all bank regulation. At the moment, why are the banks holding so much of the short-term claims? It's, of course, because liquidity regulation forces them essentially to hold these excess reserves from the central bank. So this interacts very strongly with the central bank and has implications how big the central bank's balance sheet should be in this regard. Let me just say, and then of course it is the case that it is recapitalizing monetary policy is affecting stealth recapitalization. There are more income effects rather than substitution effects playing out. Let me finally say something about volatility and resiliency. I think there are two ways you can measure stability. One is just looking at the volatility, which is just having a concrete wall, essentially, you said, I don't want to be there, and it's more about the standard deviation or variance. The other thing is resiliency, where it's more a rubber wall. So there's a shock. You give in at that time on the shock, but then actually there's stronger mean reversion along this. And I think we should focus more on the resiliency component rather than on purely measuring the volatility. If you have a resiliency aspect to it, we can have sometimes facing a bigger shock. As long as we are coming back, this is actually an easier way to deal with a certain situation. I'm running out of time, so it's... let me jump over that and let me just summarize briefly. Again, I think what happened in the last 10 years, away from impulse response, stock flow analysis, more to a volatility dynamics, risk focus, from a risk in isolation for an institution to the spillovers, from systemic to systemic risk measures, away from measuring just contemporaneous risk at this point in time, which is very misleading, towards analyzing hidden risk, which might suddenly appear when the crisis materializes. And then we have to be aware that it's not so simple just putting things in separate boxes. The separation principles we have to be very careful about, because everything in the crisis tends to be interlinked. And finally, I think there should be a focus more on resiliency on top of purely volatility measures.
Thank you very much, Marcus. Let me turn now to Benoit Karev of the European Central Bank.
I'm not sure. Yeah, it is. Good. So, good evening. It's very difficult to pay justice to all dimensions of Andy's paper, because there's even much more to it than what Andy actually said here. So we could spend a whole week discussing it, which is probably not what you want to do tonight. So I will try to be focused, and let me start by saying, right, first, that paper is very timely. It comes at a time where the regulatory community want to take a step aside and look back at what has been achieved since Pittsburgh and review and evaluate. And the FSB will have this big evaluation project which is starting. So the paper I think is very helpful to put a little bit of analytical structure on it, which we're not very good at doing. So it's good that you're doing it. And second, I agree with most of the conclusions. So I will be very focused. I agree that the higher capital requirements haven't led to lower lending. So, and that lends some credit to the assumption that capital requirements could have been calibrated at a higher level. Notwithstanding the TLAC, which you mentioned, which adds a little bit of complexity. Also notwithstanding the fact that it could look different in an environment with higher rates generally. So the kind of Modigliani-Miller distortion that capital requirements introduce are very benign today, but they could look different in an environment where the whole credit structure would be wider. So that's an open question. And I also agree with the conclusion that different rules are complementary, and that what you call the multipolar regulatory regime, which I would call silo-based, is probably what we need when we know so little about the consequences of the different rules. So this I agree. So let me focus on two issues. First one is about regulatory spillovers and precisely this silo-based approach or the multipolar approach to regulation. And the second one is something which you've not developed too much, which is about financial structures. And I will make the hypothesis that financial structures are to some extent endogenous to the way we do regulation. And that's something that we're not very good at looking through. So the first point is on the trade-offs which are involved in multipolar regulation. And again, I agree with the main conclusion of the paper that it's probably right to have the regulatory system being over-constrained when we look at banking regulation. But the point is that everything that we've done since Pittsburgh has created a financial system which is much more diverse than it was 10 years ago, both in the way risk is being intermediated, and that's about non-banks rising and doing risk transformation the same way as banks do. And that's also about the way risk is being processed, pooled, and redistributed. And that's in particular about the rise of CCPs as engines of risk transformation. And that was not the case 10 years ago. And when you move to a system which is very much focused on banks to a system which has a more diverse set of actors, the risk is that regulatory spillovers can be more likely and can be also more difficult to identify. So just to give you an example, which is an issue I've been spending some time on, which is the interaction between bank regulation and CCP regulation, and more practically the interaction between the leverage ratio and the clearing mandate. We have central clearing, so you have you have clearing clients depositing margins with CCPs. These margins are accounted for in the leverage ratio. So the leverage ratio is non-risk based, as it should. But the mere fact that it does include the initial margin and the variation margin creates a disincentive to central clearing. So here you have a trade-off. And it's not that clear where we're standing, on which side of the trade-off we're standing. That's something we have to look deeper into. But we have a clear trade-off which did not exist before the reform started. And there could be many more examples of it. So that's the kind of issues we'll have to look in more depth. And by the way, the FSB will do it. We'll have the review of incentives to central clearing under the barbaric acronym of DAT, Derivatives Assessment Team. So when you will hear about the DAT, that will be about whether the leverage ratio is rightly calibrated or not rightly calibrated. But that's an example. And that's something that is very, very difficult to address for us, because if you would like to characterize these kind of trade-offs, you would need first to define a loss function between the social value of central clearing and the social value of higher leverage ratio, for that matter. How do you define the loss function? How do you put weights on the different objectives? And then you would need a model which is granular enough to have CCPs and banks and the kind of interactions between CCPs and banks, and we don't have it. And we're still a long way from having it. So it's very difficult to put numbers on this kind of discussions. And one other example is, which is pretty obvious, is international spillovers. And coming back to CCPs again, now that CCPs are big, super systemic infrastructures, we need to be serious about cooperative oversight of CCPs. And we still have some way to go before we have proper cooperative oversights of all large CCPs. So that's also an example of a regulatory spillover, which did not exist some years ago, which is in a sense the outcome of what we've ourselves created since Pittsburgh. And the European proposal to have a new third-party regime for CCPs is an attempt at dealing with it by providing instruments to properly supervised risk being created outside of the EU. It is controversial, but it is one attempt to deal at this kind of spillover that weren't there some years ago. My second point is on financial structures, and it's more difficult in a sense, because I'm not sure that we've properly accounted for the fact that our own supervisory or regulatory decisions or the regulatory stance can have an impact on financial structures, which can work through either some forms of financing receiving preferential treatment or by protecting incumbents from competition, which are two ways where this can have an impact on the financing mix. So, in a sense, the regulatory decisions, the regulatory framework has allocative consequences for the way the financial system works. And regulators are really caught between a rock and a hard place. If you can't ignore the effects of regulation on the financial system, because that would be delusional. It has an impact on the financial system. At the same time, if you want to internalize too much the impact of regulation on the financial system, you run the risk of moving from a prudential mandate to an industrial mandate, which is, I believe, a deadly sin for a regulator. Not everyone would agree, but I think that creates a huge risk of confusion in mandates and instruments. And for long, the academic research hasn't been very helpful because it has more or less considered that different financial structures were equivalent from an allocative standpoint, but it's no longer the case. So we now know that moving from a bank-based system to a market-based system is helpful when you move closer to the technological frontier. And that's what we're trying to achieve in Europe with the Capital Market Union. So also the kind of academic evidence that we have here has changed. And that comes at a time where banks themselves are challenged by technological shifts. And you've mentioned fintech, which is an obvious challenge to the future and the profitability of banks. So one question we have here is how much should regulators care about it? And I see two scenarios for the future. One scenario is one where banks will rise to the challenge and they will internalize all the technological change. They will join forces with startups, etc. And that outcome would probably be benign from a regulatory standpoint because we know how to regulate banks, so it doesn't change much to the landscape. But there are crucial assumptions. First, it assumes that banks will be profitable enough to be able to invest in that kind of new activities. So in Europe, that would mean that they have to cut costs and they have to address NPLs in a more forceful way to be able to do it. And it may create different challenges for regulators. For instance, if we want to let banks reap the benefits of economies of scale, which are inherent to new technologies, while not recreating the risk of too big to fail. And that's something that is still ahead of us, in a sense. How much do we want to let banks look more like Apple and Google without recreating too big to fail? I don't think we have a proper answer to that. So the last remark, and I'm done, Adam, is that this is not only about regulation. It's not only a challenge for regulators. It's also a challenge for central banks. And I would argue that to some extent, as much as financial structures are to some extent endogenous to regulation, they are also endogenous to the way we do monetary policy. And Marcus made the point minutes ago that the size and composition of central bank balance sheet has an impact on financial intermediation, and I'm quite sure that Jeremy also will make that point. So we have to be mindful about the impact of our own decisions on the future of financial structures. And there are a number of examples. Negative rates are an example. So far, we are very comfortable with the conclusion that negative rates haven't harmed financial intermediation, and that the general equilibrium impact of negative rates and the other monetary policy instruments have dominated by far any negative impact on bank profitability. But that could change over time. So that's something we have to monitor. Same for QE. And it's very hard to believe that central banks keeping very large balance sheets for a considerable amount of time would not have an impact on financial intermediation. So the point I'm making here is, in a sense, the opposite of the point Jeremy has made, which is that you may want central banks to have large balance sheets because if you believe that commercial banks are not doing it the right way, or that the kind of externalities created by liquidity creation in the commercial banking system are too harmful to society. And are not addressed by regulation. I'm making the opposite point, that if for monetary policy reasons we keep a very, very large balance sheet for a very long amount of time, you may crowd out financial intermediation in a way that can spill back into monetary policy. So I'm not arguing that central banks should have a different mandate. We have a price stability mandate. So that matters only to the extent that it spills back into monetary policy or that it would have an impact on non-monetary policy transmission. But the longer it lasts, the more likely this is going to happen. And I stop here, Adam.
Thank you, Benoit. Nellie Lang of the Brookings Institution.
push this up button? Okay. Push the down button.
We're in Australia. Push the down button.
Okay, so thank you very much for inviting me to be here. I do recommend that you all take a look at, I'm going to go back. Okay, to read Andy Haldane's paper. It's very nice. It's a very comprehensive review of the state of financial stability policy and research, and it is a very convenient time for a stock take. He mentions also multiple areas for further research, and I'm going to sort of take up two of these. And the two are models of how the financial sector interacts and affects the real economy, and second, the governance structures for macroprudential policies, which are actually very important for taking actions. And you should take my comments today in the spirit of work in progress, next steps in financial stability. Let's see. So first, on the models, let me just say, Andy points out that the Bank of England, as early as 2009, where macroprudential policy was sort of still just a word that wasn't well known and repeated, raised the questions of what are the objectives? And should it be the resilience of large institutions and markets, or should it be the credit cycles, trying to smooth credit cycles of households and businesses? So for economists, there's arguments for both, lenders and borrowers, creditors and debtors, since there are negative externalities associated with each if either of them become stressed. So then you get a bunch of different kinds of tools. You can have capital requirements like the CCYB, or you can have LTVs for the lenders, but there's a whole bunch of different tools. And then there are arguments for structural versus dynamic. And I guess I would make one point on the dynamic policies. There are important reasons to consider dynamic policies and not just think about structural. One, risk-taking appears to be pro-cyclical. Two, regulations appear to be pro-cyclical. And regulations can be arbitraged. And in the US, in a very market-based economy, this is not an abstract concern. But I am very sympathetic to implementation's not easy. We don't have reaction functions. We have multiple tools. We have multiple targets. We don't even know what the arguments in a reaction function are. So in this vein, I'm going to mention a couple things that are ongoing. Again, recent developmental stage work in this, which try to develop measures that express financial stability risks in terms of risk to output or real activity. And I'm going to mention just three exercises. Down. Okay. So this first one is just an illustration. It's a VAR, but it's a threshold VAR, so we're going to allow for some nonlinearities. We talked this morning about just VARs. And it looks at whether the effects of financial conditions on economic growth vary with macro financial imbalances. In this case, like private non-financial credit, and we use a credit gap here. So you define an excess credit gap has been used, or a credit gap or excess credit, some measures, have been used by many countries in helping them thinking about implementing the CCYB, or the countercyclical capital buffer. So this is a threshold VAR based on U.S. data, 1975 to 2014. And the idea is to see if the effects of financial conditions on the economy vary by whether you've got a high credit gap or a low credit gap. And just think financial conditions here, don't think too technically. They're sort of indicators of financial stability risks. And what this shows is and we use red lines and blue lines. And so in red line periods, that's high credit. So you shock financial conditions, and you find that looser financial conditions, a shock to it is loose, is going to boost GDP in the near term quarters, and it's going to be a little bit higher in a high credit period. But then in the blue, which is the low credit, but then you can see it's like it falls, growth declines, you have a recession. It's just basically less sustainable. So this allows sort of for these nonlinear effects. There's some work here that looks at robustness, that this high credit's not approximating for other factors. A second exercise, which takes a different empirical approach, that I'm going to just mention. It was presented in the IMF GFSR current chapter 3. And here they develop a measure of growth at risk as a measure of macro measure of financial stability. And what they're trying to do is look at whether financial sector conditions can predict the probability distribution of future GDP growth. Mainly, and they're obviously interested in the left tail of the distribution, the downside risks. And this chart shows the 95th, the top, and the 5th percentile of predicted year-ahead GDP growth based on financial conditions. This is averaged for 21 countries, so some of the variability is lost in the averaging. And this is work that's built on work by Tobias Adrian and co-authors when he was still at the New York Fed. And the takeaway from this work is that financial conditions can shift the distribution of future growth. And they find that tighter financial conditions, which are based on asset prices, are predictors of greater downside risks in the near term, say like a year ahead, which this shows. And in the medium term, the greater downside risks tend to be brought about by, say, higher borrower leverage. So in this sense, there's a little bit of consistency with what Marcus mentioned, a volatility paradox, that you can get looser conditions, can reduce your growth volatility in the near term, but maybe increasing them in the medium to long term. So basically, this measure is, again, trying to put financial stability risks into the same language that's being used to assess other macro risks. And you could imagine countries could develop such a measure over time, gives them a sense of the need for macroprudential policies or, in something imminent, a crisis management policy. And a third exercise is basically to continue to extend this and condition it on whether credit is high or low, similar to the first exercise I mentioned, which allows even more for some nonlinearities. And for advanced economies, sort of some preliminary work suggests that these kinds of nonlinearities exist. So these 3 examples are basically testing and finding results that are consistent with a framework for financial stability as the ability of a financial system to absorb shocks rather than to amplify shocks, and they allow for greater downside risks and nonlinearities. Okay. My second area I want to pick up on is governance for macroprudential policies. And this is basically asking a question, who makes the decisions about macroprudential policies and what kinds of, are the governance arrangements effective? All countries have pre-existing microprudential regulatory structures, and they have central banks. And neither were really designed to implement macroprudential policies. And those kinds of policies require a great deal of coordination across regulators. They may need focus on time-varying risks. Many of these skills don't cross regulators. So in a new paper I've been working on with Rochelle Edge, we thought we would try to collect some information about what these new authorities look like. And we constructed a data set of authorities for 58 countries. And it's based on public official documents. You look at the central bank websites and the financial stability things. Reflects information through 2016. So what we find, and I just have 2 simple bar charts to simplify a few things. 41 of the 58 countries have established financial stability committees or councils. Most of them have been established since 2010. And 15 countries have designated a single entity to be the macroprudential authority, and that's generally the central bank. Now, if you weight by GDP, so the blue line shows what we call the FSCs, the financial stability, the blue bar, and the lighter blue to the right is weighted by GDP, just to give a sense. So you can see that it's the bigger countries that have created the committees. And if you actually think about global activity, this is basically it. The central bank, the countries that have set up the central banks as the authority don't account for that much. Okay. Then we looked at the membership and the leadership. So most of these committees have 3 or 4 members. A central bank is always on it, 1 or 2 prudential regulators. The Ministry of Finance isn't always on, but when it is, it's almost always the chair. So the next chart to the right shows that the Ministry of Finance is, the chair about twice as often as the central bank. That raises issues about implementation and whether there's any present bias, I think is the word I heard this morning. And by the way, prudential regulators are always on the committees, but they are never the chair. Maybe there's one country. So it was clearly they're just sort of delineating responsibilities. Now, judging the effectiveness of these committees is really subjective. I'm going to throw out three things, which the IMF has set out as being important. Can they coordinate? Are they able to take actions? And are they willing to take actions? So on coordination, all the committees work to promote information sharing. They all say that. And they seem to have the right setup for the membership, and we do a little testing in the paper. This seems like a good step forward. There is coordination. On the ability to act, we looked at whether any of these committees themselves had specific tools. Did they have the authority to set a countercyclical capital buffer, implement a stress test, set an LTV? We found that actually only two councils, the UK and France, have what we call hard tools that they can direct an action of any of its members or itself. Another 9 have comply or explain, which means they can sort of express a view that somebody should do something, but that agency then has a choice to say whether they think they should do it or not. That means most of these committees meet just to share information. Now, the separate regulators continue to have these authorities to set the policies, and the central banks can provide the sort of time-varying risk analysis. But many regulators themselves do not have financial stability mandates. So there may well be a very big disconnect in many countries over the authority for tools and the responsibility for financial stability. Willingness to act, I think, is too early to tell, and it's the hardest. But I think this point that they don't have tools, they're running by the Ministry of Finance, suggests that there are some challenges ahead. So I think one takeaway from this is, in the meantime, monetary policymakers or macro policymakers should not assume that there are these new committees in place to offset procyclicality. Okay, and Jen, I guess to conclude, there's just to repeat, I'm optimistic on models that make progress on defining targets and assessing nonlinearities and linking them to the economics. But we're pretty far away from setting policies. And there's clearly a need to invest in creating accountability for financial stability. Okay, thank you.
Thank you very much, Nellie. Finally, turning to Jeremy Stein of Harvard University.
All right, let's see. Is this thing going to happen?
It will.
Do I need to do anything, or will it
No.
just... All right, well, let me just start. So this is a terrific paper, as the other discussants have mentioned. It covers a lot of ground. I agree with much of what Andy has to say, and in particular, there's a big part of the paper which I think basically has the message that we're probably at the low end of the ideal range on overall capital, and that some of the most dramatic complaints that the banks had about loan supply have not been borne out. So if anything, if we were going to err in one direction or another, we might err on the side of increasing it. So I agree with that. What I thought I would do is spend my time.
Our elves are.
Okay.
I'm
going to spend my time on.
I'm sorry.
I think there is one place where we do have different views, and that's holding fixed the level of capital. How do you implement it? And in particular, the whole belt and suspenders thing. I didn't get you had a kind of British joke about suspenders. Yeah.
Braces, suspenders.
I don't think it's a good look. So that's basically the point of my discussion. I'm not a fan of belt and suspenders. I tell you, I actually have tried on and off over several years to try to think analytically. What is the lot? Is there a model in which you can actually make sense of sort of the informal logic? It's really hard. So that's the point I wanted to make. But I could kind of use my slides. All right.
I'm terribly sorry.
No. So let me start. Let me start with the cons, and then I'll come back to the pros. I'll come back to the pros that you raised. There's two sort of obvious cons, I think. So actually, let me be clear. I'm not arguing in any way against capital and liquidity requirements, because I think those are distinct. I'm arguing a narrower point, which is, in the world of capital, do you want to have two binding constraints in some sense on the same item, which is how much equity, okay? And you know, the concrete thing is a risk-based capital requirement and a leverage ratio, which in the US has been dialed up pretty substantially via the supplementary leverage ratio. Okay. An easy argument I think everybody sort of appreciates is if the supplementary leverage ratio is calibrated so aggressively that it actually binds. Oh, look at that. All right, move the little bubbles and everything. Okay. If the thing is so aggressive that it actually binds, well, then you're left with just an unrisk-weighted ratio, and that has kind of some goofy properties, like it's pretty tough on treasuries and on repo and all that. Okay, and there's some evidence that it's been binding, at least in the U.S., and that it's had some effect on treasury markets. I'm going to sort of set that aside and focus on a sort of subtler, what may be a subtler point, which is if banks are heterogeneous and have different business models, and in particular different ratios of risk-weighted to not risk-weighted assets, one constraint may bind for one and another constraint may bind for the other. So concretely, think of Wells Fargo, sort of a typical bank. It's got a relatively high ratio of risk-weighted to total assets. It's more likely to be bound by the traditional risk-based. Think of Goldman Sachs. It has more securities basically on its balance sheet, so it's more likely to be bound by the other. So they're now going to be operating essentially in different regimes. It's like operating in different tax regimes. And that's going to create some forces towards migration that basically for Wells Fargo, they're not bound by the leverage ratio. They don't face any marginal risk charge for like treasury securities. So they ought to do like more investment banking. Lo and behold, Wells Fargo is doing more investment banking. Okay? Goldman Sachs is going to think, geez, if I only had a bank, this leverage ratio wouldn't be preventing me from doing the stuff I like to do in the repo market. So lo and behold, they're going to acquire a bank, which they have done. So, you know, that's the concern. And basically, if you just work through the algebra of it, what it does is it drives everybody essentially to some kind of a universal banking type of model. So, so what I've got here's just a picture of which constraints bind or are closest to binding for different banks. Don't stare at it too hard. What it's basically saying is the bankier kind of banks, those that are more kind of traditional commercial banks, Wells Fargo, U.S. Bancorp, PNC, tend to be bound either by a pre- or post-stress version of a risk-based ratio, whereas many of the others, the investment banks and the universals, are more bound by something like the supplementary leverage ratio. So what you can do, this is a bit of a project, but basically you can take for each bank, assume it's operating under only its most binding constraint, and then you can think for each bank in each type of activity, what is going to be the marginal risk charge given that most binding thing. This is my multiple tax regime point. Let's see, do I have a laser pointer? So, you know, the point here is if you look at Wells Fargo, which is bound by the Tier 1 ratio, it has very different capital charges than some of its peers. And in particular, it has relatively high capital charges for a lot of lending types of activities, but a much lower capital charge for securities type stuff. And you can see that this has changed behavior. So this is a regression where on the horizontal axis, we've got the bank's initial RWA to A ratio as of 2012. And again, there's sort of a natural pattern where the banky banks are down here, Wells Fargo, PNC, and U.S. Bancorp, and either the custody banks or the investment banks are up here. And what you see is essentially a convergence. So we're looking at the change in risk-weighted assets to assets as a function of the starting level, and there's a very, very strong relationship, which again, the shorthand version is Wells Fargo is sort of moving in, or guys like Wells Fargo are moving more into investment banking type stuff, and the investment banks are moving more into banking stuff. And so the prediction is we're going to get guys looking more similar. So that would be the concern. Now let's take some of the arguments on the other side. So this is a couple of the ones that Andy highlighted. And I just want to be careful on the tone here. The concerns that animate the leverage ratio are centrally important. Okay, absolutely important. And it's just a question of whether the right way to deal with those concerns is by having sort of a competing capital standard or by trying to integrate those concerns into essentially a single rule. Okay, so for example, there's this sort of idea of Knightian uncertainty, which is, who knows what the risk weights are? Surely the standard risk weights are wrong in some sense, and wouldn't it be good to have another sort of alternative just for robustness? So here's the analytical proposition, which is, tell me whatever your favorite calibration is of these two things, okay? Now think about a representative bank. That calibration is going to amount to, like, it's going to have a multiplier of 0.8 on this constraint and a multiplier of 0.2 on the other constraint, right? It's going to be doing some averaging, okay? I would prefer to then take a single constraint that is the average of those two. That gets you the same thing for the average bank, but it gets rid of the heterogeneity. That's the thing where I have a very hard time sort of thinking about the logic of there being two, because I can always, in some sense, take the virtues. So, you don't like there being a zero risk weight stuff on stuff that looks low risk, because we know it's not. So absolutely, weight it up, okay? I don't know that that means you want to go to the extreme of having a uniform risk weight, but that's sort of the idea, okay? Let's see, how am I doing on... Okay, so the other point, again, an enormously important point, and you had these pictures, the risk-based requirements can be gamed. Yeah, they absolutely can be. But of course, and you showed that historically, the leverage ratio performs better in terms of predicting distress than the risk-based stuff did. Well, of course, but that's in some sense Goodhart's law, which is the risk-based stuff was the stuff that was the thing that was in force. So that was the thing that was being gamed under the old regime. My prediction is if you make the leverage ratio be more binding, it will be gamed as well, and you're going to be sort of back to square one. So the problem is not, I don't think the problem is so much with the risk-based thing per se, it's with the rule. I mean, financial regulation is just a terrible, terrible business to be in, because, no, I'm not kidding, it's not a joke, right? Because it's a sad thing, but it's because of the sort of the timing of it. You move, you write a capital requirement, you set it in stone, and then guys have at it, right? So, what needs to be done to some extent is to change the timing of the game, to see, can I fill in some of these contingencies ex post after the banks have moved? So in our view, you got to do something with this, but the something might be to try to use the stress test, for example, as a way to do some filling in of contingencies ex post. So for example, what we have in mind concretely is you have a relatively simple and you understand going in, it's going to be a far, far from perfect rule. And then you each year when you design the stress scenario, you say to yourself, I'm going to look ex post, what are the banks doing? So what are the areas where they have been growing rapidly? Who are their 10 most highly compensated traders? What are their exposures? Stress those. Okay? It's understanding that you can't ex ante write the contract no matter what you do. You can't write the contract all that well, and there needs to be a little bit more reliance on using the stress test or some device like that to fill in ex post. Okay, so that's the basic story. Again, I think the sort of thing that has animated Andy's work and others who have sort of argued for multiple constraints are absolutely at the center of the problem. And the regulatory arbitrage in particular is at the center of the problem. I just don't know that the problem is solved by essentially, trying to replace one bad rule with another bad rule. And then the last thing I'll say, and this sort of I think resonates with your earlier point, is another motivation I think, especially in the political arena for say the leverage rate, is just a general desire to be tough. It's just you're more constraints, more likely to be bound by one of them, and it's just sort of going to raise overall capital, which I think is great. But I think that you can do that again by doing something like dialing up the GSIB surcharges rather than by having multiple rules. Okay.
Thank you very much, Jeremy. Andy would probably love to respond. I have a couple questions I'd like to put to the panel, but I'm conscious we've run long and more that we have enormous expertise in the room. So let me open it up to questions. Again, the drill is we have a couple roving monks up front. or if it's easier, come to the standing mic. No matter how brilliant and famous you are, please identify yourself when you ask a question so I don't have to. Please.
I'm going to start out with somebody who's not brilliant or famous and does not have a deep reservoir of knowledge, but this is for Jeremy.
Then what's your name?
Peter Coy from Bloomberg Business
Thank
Week.
you.
Thank you. Randy Quarles has been one of the people who has been sympathetic to the bank's view that the Fed stress tests are arbitrary and that it's unfair to change the rules year after year. And yet, the way you described it, that's exactly what we need. So where do you stand on that?
So I think this is the essence of the problem. So I freely admit that, doing what I suggest and sort of having these stress scenarios change is more discretionary. It feels less like, I guess, due process. You could imagine challenges, I suppose, under the Administrative Procedures Act. But it's in some sense the central tension. I think, obviously the banks, it makes sense. They would like to have transparency. That is, kind of tell us what's going to be on the test. But then the whole stress test thing really, at least in peacetime, just devolves to another complicated capital rule. If it's going to have sort of a distinctive benefit, I think you have to at least be willing to try to push it in this direction. I acknowledge that there are costs, and I mean the one way you might sort of try to find a medium, if you will, is transparency has a couple dimensions. You can think of ex ante transparency and ex post transparency. So I think this theory suggests there's a limit to how far you can go with ex ante transparency. You can't just tell them exactly what's going to be on the test. I think at the same time, the Fed could do much more in terms of ex post transparency. They can explain this is the way we varied the scenarios. This is the reason for why we varied the scenarios. Importantly, one thing that they don't disclose now is these are the risk weights that were implicit essentially in the scenarios, because if we had this kind of losses on small business loans, you have a high capital charge effectively on small business loans. So I think they can do some of that. But I think if you capitulate to the desire for perfect ex ante transparency, you've neutered a sort of important potential virtue of the stress test.
Does anybody else from our panel want to comment on stress testing in general or specific? Nope. I'll just remind people we have published a couple months ago a book by Morris Goldstein on this topic, which I think in some ways comes down similar to where Jeremy does. Next question, please. Jose. You, Lorenzo, go.
I feel that I want to be a bit provocative.
Lorenzo
means Maggie. Now I am a banker. So it's a kind of, I don't know in the Frisbee thing, if I'm the dog, if I'm the Frisbee, I never really understood. But I understood a lot from this session, what the incentive of the regulator is. But just as a question or thoughts, I'm not so convinced about your story, Andy, although I didn't really read the whole paper. I didn't have the 10 minutes warning, because in the end, you have a nice story that, we should have 19% capital. Why don't we have 19%? Although it doesn't have an impact on credit, and I'll come back on that one. I really sometimes wonder where you live, in which kind of world you live. Because the world is complicated, so it's better to have different rules, and so we can have lower capital with all this TLAC and NSFR, and you have these nice simulations. But I would suggest what Jeremy Stein said, that once you incorporate this into a new world, it's not going to be that easy to catch, because the banks will make a combination, an optimization of capital and liquidity that will make it again difficult for the regulator to catch you. So the truth is that higher capital, at least in a transition, makes credit more difficult. And you can see it. Otherwise, you will not be doing QE. very long-term refinancing operation in DCB and so on and so forth. So in the transition, if you move from one capital level to another, you will have an impact, and we have seen that. And I'm not convinced by the BIS papers. The BIS paper is a comparative static paper. And of course, in an economy which is well-performing, higher capital is better than lower capital, but you have to get there. And coming out from the crisis, it has had an impact on credit, I think. But the key at the end of
do you want to put a question mark
yes,
at some
the
point?
end of the question is the last point that you raise, which in my view is fundamental. Is the financial sector too big? Or maybe you want to generalize. What kind of financial sector do we want? And this maybe should be the first question, not the last one. And maybe you could say that this is not the role of regulators to ask this question. But if you don't ask this question at the beginning, you, as a regulator, become involved with it and have an impact of it. And I think that if you put the capital requirement at 16, 20, or 25, you will have an impact, or maybe I should put this as a question mark. You could have an impact on the structure of the banking system. And if you look at...
I'd settle for a period, actually.
Yes. And if you look at the banking sector and those that have these kind of capital ratios, they have monopolistic power. And is this desirable or not? I think that's the question that the regulator has to ask.
Lorenzo, enough joking.
Yeah. So the question is, shouldn't you start by where you ended? I mean, what kind of financial system do we want in different countries, of course, and start your regulatory framework from that, rather than asking the question at the end, which may be suboptimal as a result of your willingness to catch the frisbee.
To restate, what would be, should you start with what should be the optimal financial system? And if you did, how would you go about defining it? Andy.
Thank you. Lorenzo, you've changed since you became a banker. So I think that is a good thought experiment. But in some ways, that is the one we're about to engage on. So I think the priority immediately after the point where the boat was sinking was to fill the leaks in the boat. And in some ways, that is a job we've been doing for the last decade or more. The public rightly don't forgive you if you don't fix the known problems. And in some ways, that's what we've been doing, I think, fixing the known problems, market failure by market failure. And now's the point, having patched the boat, to ask the question, where do we now sit? Is this actually the boat we want? Is it able to furnish the needs of the real economy in the way we would wish? I think that is the essay question that is now posed to us, rightly posed to us, because it's the one that society is posing. And I hope it's one that we can come up with a decent answer to. I should say on that front, I think some of the direction of travel has been pretty positive, and Benoit mentioned this. So the fact that Europe, including the UK, is moving in the direction of having a second engine, in other words, a non-bank engine, a market-based finance engine, is very much the right direction of travel. That's a different boat than the one we had previously. It means the system is more diverse and therefore resilient, I think, than would have been the case in the past. So I think some of that's happened on the fly, and some more of it will happen, I think, in the next decade. It's the right essay question. On credit and capital, I mean, in some ways, Hyun is here and has a paper that speaks to this question, which is a slightly different conclusion, as would a number of other papers in a similar sort of direction. I wouldn't say there's nothing here, Lorenzo, by way of tightening credit conditions, but it's, for what I've seen, it's no greater than was already figured in the calculus when we arrived at the initial numbers.
Thank you, Andy. Would anybody else care to come in? Yes, Benoit.
No, I can say a short word on just to illustrate one of Lorenzo's point, which is the the adverse impact of capital ratios on lending. I mean, if you look at the Eurozone back since, say, 2007, 2008, you had starting in, say, 2011, 2012, you had a consistent and very quite steep increase in CET1 ratios for large Eurozone banks, and at the same time, you have an acceleration of credit. So the correlation is that way. It's positive.
Anyone else? Oh, come on.
And I would just add the evidence from the U.S. would support what Benoit was just saying. I think we've gotten to a place where higher capital and higher growth have this positive feedback and not a less lending. And it's the strong banks that are resilient to shocks and can continue to lend. So there is a transition, absolutely, but in some sense, Basel tried to address that by a long transition period that works only somewhat since everything gets pulled forward, but there is in practice an opportunity for banks to transition, take a longer transition period.
Jeremy?
Can I just say one other point on the capital and transition? So, your point is essentially that the flow cost of raising new equity is higher than the steady state cost of having it on the balance sheet in some sense. So that's the sort of timing. So that's, of course, completely right. Those flow costs tend to be private costs more so than social costs, like guys don't want to dilute their shareholders. And the implication of that, so for example, the extreme case of this is during the financial crisis when the capital is really depleted. I don't think that the right answer is that we should have low capital. It's that sometimes you need to focus not just on capital ratios, but on dollars of capital. So I thought the central design insight of the 2009 SCAP was when the stress tests were done, we didn't look at Bank of America and go, oh, you don't have a lot of capital, you need to improve your capital ratio by 2 percentage points. We said you need 33 point whatever billion dollars of new capital. So they didn't have the ability to kind of get to the ratio by shrinking assets. You had to push. I mean, policy has to not take these flow costs as just a given constraint, but has to push against them. So I fully agree that they're there, but again, I think they're more in the vein of private than social costs. So that's something where my wish for the stress test next time around when there's a stress scenario is that policymakers have the resolve, unlike in 2007, to be more aggressive about essentially cutting off dividends and compelling new equity issues.
Thank you very much. Another question. We can probably fit in 3 in that amount of time. Yes, next person.
Ferdinando Giuliano, Bloomberg View. I have a question for Andy Haldane about the key question which he underlined in his presentation, which is basically whether you can reduce capital requirements just because you think you have an effective resolution regime. I mean, you seem to suggest that's the case. Now, I have two doubts with regard to that proposition. One was actually pointed out in your presentation. How credible are these resolution regimes? We just don't know, particularly for large banks. And the second point is, if you have in mind multiple constraints or multiple rules, I wonder whether this is undermining that logic, because in a way, just because you have a resolution regime, you are making the capital requirement bit less effective by lowering it. And I know this is very important also for the Bank of England, because I believe you've taken a decision not to enforce the full systemic risk buffers, partly because of this idea that resolution regimes can, I think John Vickers pointed out that was a mistake you made last year. So I just wonder whether, not just you, but other people on the panel had comments on that.
So I think that the question is the right one, and it's true enough that at this stage we cannot have the case law on whether the shiny new resolution arrangements that have been put in place statutorily throughout the world and the accompanying non-equity sources of bailable debt will indeed be bailed in the sort of situations of stress that we saw during the crisis. So I have a lot of confidence that if failures are small and singular, that this will be relatively easy to pull off, and US experience over many decades speaks to that being the case. But the rubber hits the road, and this only really has resonance in the systemic states of the world that you mention. In those states, I do think that a lot of talk today about the time consistency problem as it pertains to monetary policy. I think that is as nothing by comparison with the time consistency problem as it pertains to financial stability in those systemic. And I'm just saying that as Adam sat next to me. I absolutely believe that. I think the problem, both on the way in, given the longer duration of build-up of stress and the scale of the cost when stress hits, means that the knife edge, the non-linearity, is that much greater, and therefore the pre-commitment problem is that much greater. And if you look at the history of bail-in debt's got a history of at least 150 years, and bail-in has tended to be honoured in the breach. It hasn't happened for just these reasons. Because if you were the finance minister or the treasury secretary of the day, faced up against, do I write the check or do I punish the widows and orphans? It's easy to know which choice to make. Will next time be different? I hope so. And lots of thought, much more thought than ever previously over this 150 years, has gone into the design of instruments and design of regime that can make it materially more time consistent than any in the past. But ultimately, this is in part an act of faith, and only time will tell.
Let me say, since Larry set the model that one doesn't have to be a neutral chair, one can editorialize a bit. I'm nodding vociferously, not because I'm 100% in agreement with Andy or because I fully have his sophisticated views, but 2 weeks ago at his conference, I was pushing the idea that the time inconsistency moral hazard problem for policymakers and regulators is far worse on the financial side than monetary side. And we've spent so much broken crockery through the years, including recessions and hard money constraints, to prove we're tough on time inconsistency, and then we wring our hands about proving we're tough and perhaps taking away some of the discretion from policymakers and say, oh my God, it's a terrible trade-off on the banking side. And so just the spirit of Andy's comments, I at least think I'm very much in favor of. But allow me to let the real experts speak. Is anyone else care to come in on this? Yes, Benoit.
Just one short remark, exactly. To that discussion on time inconsistency. There is always a trade-off between ex-ante incentives and ex-post incentives. So that's not new, and it's much more severe in the field of financial regulation than in the field of monetary policy. I agree with that. But if it's only between ex-ante incentives and ex-post incentives, it's fine. But what we've seen is regulators being soft ex-ante. So at least you want it to be a trade-off. Yes. You want to see the trade-off. And so if you're too nice ex-ante, it's not even a trade-off.
Can I just point out?
Please, Mark.
So I totally agree with it that time inconsistency on the financial regulation side is much more pronounced. But on the other hand, we have also heard we would like to have more discretion on stress tests rather than rules. So typically when we have a lot of time inconsistency, we need more strict rules and more binding constraints. On the other hand, rules will be gained. So this makes this whole playground even more dangerous and difficult to handle.
Interesting. Okay. Another question, please. There, if you could stand up at the mic. Thank you.
Yeah, I'm Christian Kopfnord, Union Investment. Andy Haldane, you argue that if you impose a leverage ratio in excess of 3%, then you get more false alarms when banks are fine. Actually, my question is, so what? So what actually is the social cost involved in there? What is the actual cost to the economy? And likewise, Jeremy Stein, you said that if you impose a very high leverage ratio, then the system converges to a universal banking model. My question is, so what? Yeah.
And I take it, sir, you mean so what from the social welfare point of view? Thank you.
So on your first point there, so what? I was sort of I was inadvertently invoking my inner Lorenzo when arguing that anything above 3% might come at some cost. Of course, if you buy the argument that that going higher need not be costly, then that falls away. Just as I've got the floor, just on that point, many people have rightly made the point that those sort of counterfactual experiments that I showed you come with huge caveats and cautions for Lucas Rethinking, Goodhart-Law type reasons. Absolutely, that must be true. Equally, it was the case that even pre-crisis, some countries, including this one, did have a leverage ratio regime in place. So too did Canada. And actually, even in those countries that had that regime in place, the leverage ratio did a better job of picking losers than did the other regime. So that isn't a knockdown argument, but it goes in the direction that there's more here than the regime, and explaining what was going on there. It was a question also for Benoit.
This is the so what question of whether, what's the big deal if everybody becomes a universal? It's a really good question. It's sort of easy for me to go, they're all going to be universal banks. Ooh, I don't know. I mean, in the short run, you'll get guys moving away from things that they're used to doing, that they have skill at, and that's an issue. I sort of have some ill-defined sense that in a stress scenario, having everybody have the same business model may not be ideal in terms of the resilience of the system, but I'd be hard-pressed to kind of put a number or a magnitude on it. But the way I would push back is, the bar on that depends on how much benefit we're getting from this system on the other side of the ledger. So my real point would be, I think you can get many of the benefits. Again, these are important benefits that Andy alludes to with a more intelligently designed single constraint type of system. So if you can get those benefits relatively cheaply, the bar on the so what question is lowered somewhat. Again, so I would try to take a lot of the benefits of the leverage ratio. In my ideal risk-based system, there wouldn't be zero risk weight on anything. Uncertainty would drive up risk weights in general, all that kind of stuff. But again, if you do it the same for everybody, again, what's crazy about the sort of dual system is both of these regimes, which we've all sort of stipulated we don't like either one by itself. Basically, some guys are facing one, and some guys are facing the other. So you're not even getting some of the benefits that some of the robustness benefits you'd ideally like to get.
Thank you. I'm required to make one more advertisement. Our colleague William Klein also published a book with us a few months ago that takes on some of these issues and tries to say from a first principles basis, much like Andy started, what are the trade-offs of higher capital from a social welfare function? And he comes out with a lower number for capital than many of these other studies, but still at least as high as currently is held. Let me take one more question. This has been a terrific discussion, everybody. Please, someone, or else I'll ask a question. Yes, at the back, Richard.
Richard Cantor from Moody's. Questions for Jeremy or anyone else who wants to answer. You spoke of the advantage of having a single capital measure, and you also spoke of the wonders of stress tests. I wondered how those two go together. My own thought about stress tests is that if you knew the capital model you wanted, risk-based model, you would just impose that. You wouldn't need the stress test. It's probably too difficult politically to evolve this risk-based model over time as your views of risk change. And so that it's really a backdoor way of imposing the higher capital requirements on the banks that you think already need them, but doing it privately without a rule that drives it.
So let's see. So a couple points. One, I mean, you're right that, for many banks, I talked about the multiple constraint problem of there being the risk-based capital and the leverage ratio. There's another dimension to it, which is there's the pre-stress and the post-stress capital requirements. So Nelly and others and the Fed and Dan Tarullo have talked about those being merged by having essentially a single requirement where the stress test stuff feeds into, what do you call it, a risk something buffer, a stress capital buffer. Stress capital buffer that sort of and again, so then you have a sort of more in the mode of a single constraint. But then again, I think we have exactly you've highlighted once again the tension. If the stress tests are going to do something useful beyond just being part of the standard regime, you'll have to be kind of doing something a little discretionary, but it does take us away from a rule. And if you think that regulation has to be done by rules, and that's sort of the right way to do things, there's a real problem. But again, we know the problems with rules, and I think we need to at least explore whether we can kind of equate the marginal cost a little bit by pushing the discretionary bit at least a little bit more.
Would anyone else? Yes, Nelly, please.
So if I could just expand on that a little bit, I think if we knew risk weights, we could just use a single risk weight count-based system. And if the risks also did not vary over time, and it didn't matter if risks were rising and it was symmetric, it wouldn't matter. But in general, we care if risks are rising and the risk weights, the constant risk weights, don't go up with it. So I think this is this nonlinearity that I think is important. The stress tests have tried to incorporate the current balance sheet and current risks that are from the balance sheet. So stress tests let you get a little bit forward-looking and time-varying capital. It does introduce complexity, and I think this proposal to integrate using the stress test to calculate what would be sort of the capital conservation buffer would sort of help to simplify the capital regime over time. But it is a proposal, and it's probably at this point not a formal proposal, but has been out there, and with the spirit of simplifying the capital requirements, but allowing a bit of discretion because the economy is sort of it's not constant, and so you care about the downside risks more than you care about the upside risks.
Just pondering about this time inconsistency and the stress test. Perhaps one way out is to delegate it to committees and delegate to the right people who have the right incentives. And because we can't use rules in one sense.
If I might say, it's very analogous to monetary policy. If you believe that a Taylor rule doesn't work, yes, you need some discretion. But then, of course, the chair testifies twice a year and is really on the hook for explaining why they did what they did. And you try to cure the ex-ante discretion with a lot of ex-post transparency. I mean, it's not obviously perfect, but that's...
I would push
finally,
back. Sorry, go ahead.
But let me just one more comment. The problem that all banks merging because of this different multipolar regulation, of course one could make it even more complicated and say we have a functional approach. So whenever you're a traditional commercial bank, we apply the rules, all the rules to this unit, and we apply all the rules to the investment arm separately. Then you get around this merging wave phenomena. But of course, it makes the whole setting way more complex.
I think I wouldn't push too hard on the monetary analogy in that sense. There's a difference between saying there's a rule that every bank or every regulated financial institution under the appropriate remit gets a stress test every year, and broadly the terms and goals of the stress test are X. And then there's some operational independence that you can change and alter the stress test. Again, I'm not saying you're disagreeing with that, but I'm worried we're confusing levels of the problem here. But anyway, look, this has been a fantastic session. This week we sort of talked, not jokingly this morning, about technocracy and in our conversation with Larry and Olivier to start the day. This, to me, is an example of technocracy at its best, that academics, public servants, and financial sector participants, market people, really coming together and trying to grapple, in Andy's sense, of what are the risks. We got to repair the boat now, but then, as Lorenzo rightly raises, we also got to decide what's the boat we want to be in. And so I commend to you Andy and his co-author's paper. I commend to you the fact that all these discussants came in with real comments and discussions. I commend to all of you for your stamina in going through the whole day. We will close here. The Rethinking Macroeconomic Policy Conference, led by Olivier and Larry, with my catering, resumes tomorrow at 8:30 a.m. Our first session will feature a leadoff paper by Jason Furman on how and why macroeconomic policymakers should take inequality into account. Our second session, with a leadoff paper by Gita Gopinath, will be talking about some of the issues having to do with international finance and capital flows. Barry Eichengreen made the very apt joke to me at the break, which I must repeat, but he gets full credit for it. This is like the bad old days of teaching macroeconomics in the U.S. You would have the open economies chapter at the back and not think about it. I was going to raise, and that was not intentional, but I can certainly see why Barry raised that. And that's no disrespect to Gita, that's a disrespect to us. I would just say that one aspect which we didn't discuss in this session, which I know we have strong opinions on, is how do some of the setups that our colleagues were talking about here reconcile with some of the savings glut or capital inflows or intra-European transition issues of imbalances. Obviously, these panelists could talk about that very well, and maybe we'll get to do this again sometime. Thank you all very much. Have a good night.